Well, good morning or good afternoon to everyone, depending on what part of the country you are calling in from. My name is Ginger Bell, and I want to welcome you to the Finance of America commercial webinar that we are doing on rental property loans. And this is for your real estate investors. And our goal today is to give you a product overview, give you some information on how you can use this exciting program. So as you are getting logged in, there are two different ways that you can listen. You can either listen on your computer or you can dial in on your phone and listen on your phone. The phone number is on the email or it's actually on your Zoom little panel there. You can click on your audio settings and choose how you can listen there. And then you can also ask questions. We always get a lot of questions on these commercial webinars because for a lot of you, this is a new product. And so if you do have questions today, we will be taking some questions, not scenario questions, but just more specifics about the guidelines that we're going through. So if you do have questions, two different ways you can ask those questions. You can type them in the Q&A panel, which is on your screen. Just click on the Q&A and type in there, or you can type in the chat box. So either one of those will get to me. I'll be able to take a look at those and to share them with Avery and get those answered for you. And so let's go ahead and make sure that you all know how to ask questions and that you also can hear us. So if you can type either in the chat box or in the Q&A box, your name or hello or where you're calling in from. Let me know how your weather is. I actually was just in Denver earlier this week. Just got back last night, and the weather there was absolutely gorgeous. We were able to go over Trail Ridge Road. Got in a little early on Sunday before I had to get into business, and so got to experience Denver, which was a whole lot of fun. And so I'm seeing you all logging in, saying hello, sunny, sunny, sunny. This is a great time of the year. Jacksonville, yes, I am sure it is very hot in Jacksonville. And you guys are humid, hot and humid in San Diego too. Kind of crazy weather we're having. I'm in Portland, Oregon today, and it's absolutely gorgeous. So enjoying this time of the year. Okay, so you're all logged in. You can ask your questions. You can hear us. We have a handout for you, and I'm going to actually post the link to that right now into your chat box. And you can click on this link and get the presentation. You can follow along with us. I'm going to control the slide deck, so you don't need to worry about moving the slides at all. But you can click the link and get it there. Or I'm going to also send out an email. And the email tomorrow is going to include a recording to the presentation as well as the slide deck. And then, of course, we always put everything into FAMU, which is the Finance of America Online University. So if you don't get that, you can always go online and always find all the webinars that we do there. So that's it for the housekeeping. Let me introduce our guest presenter today. And I've known Avery for a little bit of time and always enjoy having the opportunity to work with him. Avery is a field market specialist for Finance of America and is really so well seasoned in terms of this product. He has been involved in the financial service industry for a long time and is just so proficient at sharing the information on this product, being able to lead as far as growth and relationships and all the things that he does, and knows this product inside and out. And I tell you, is so passionate about it. So Avery, thank you so much for joining us today, and I look forward to being able to share this product with our audience today.
Absolutely. Thank you, Ginger. I'm so excited to be talking to everyone about our awesome platform. I think that people are going to really get a lot out of it, and we're going to bring some value and get people excited about rental products.
Absolutely. And you know, one of the things that I think is so important for originators is to always find those other little niches and opportunities to keep in their little pockets to know, hey, this is an opportunity to be able to bring out. But I always know for some originators, it's a great way to be able to say, hey, did you get turned down? And I know that's something that you see and that originators even see as far as getting turned down on these investment properties. So what are some of the things that you see and you hear in the field for reasons that investors are turned down?
Well, yeah, great point. we see a lot of this in the industry, because under normal circumstances, if someone is getting a lot of investment properties, when you go to your traditional banking, most of the time your traditional community banker is going to tell you, hey, you've hit your limit in regards of rentals and investment properties. They're going to use your DTI, your debt income ratio. They're going to tell you that Fannie and Freddie guidelines only allow you to have 10. So they don't have anywhere to send you. So we built out this awesome platform that will allow investors to continually grow their portfolio, where we're taking the cash flow of the property, the performance of the property, to really, to spear and grow your portfolio in a way that maybe traditional financing couldn't do.
Well, and that's really, and you talk about this product, and this product really was developed out of a need, having that need for investors to be able to do the things. And you offer a variety of programs under this, and we're going to actually just focus on the rental properties in this webinar, right?
That's right. We've got a great suite of products with Finance of America Commercial. We do fix and flip. We do new construction from ground up. And we're going to be talking today about our two bell cows in regards to rental properties, the single rental loan and our portfolio, which allow you to do multifamily. So can't wait to dive into the details.
Absolutely. But before we do, one of the things I really wanted to open up is really the national reach that you have. But not just that, it's the national reach, but having that local, that feeling that even though it is an opportunity for Finance of America that has a national reach, for our brokers, they have that local touch. And so it's an opportunity for them to be able to grow their business and to be able to provide some options to these real estate investors.
Sure. Like what I like to always say is that, on one side there's traditional financing, right? They don't give you the opportunity to have the exposure that someone like, we will do, like in regards to private equity. On the other side, there's hard money. I know investors and lenders are always familiar with hard money lenders, but we kind of fit in the middle. I like to call it soft money, right? We're in the middle where we give people opportunities to have the exposure, but we also are not gouging in regards to rates. Most of our rates are very, very competitive across the board, whether it's fix and flip or our rental stuff. They're all competitive in regards of, rates. Not quite like traditional financing, but of course, we're giving you an opportunity to really grow a portfolio. So we really kind of fit in that gap, and I think that's a great place to be in our environment today.
Absolutely, it is for sure. So let's get into the details and let's talk about the rental properties. I'm going to start out with talking about what are some of the highlights that you have for doing loans with rental properties.
Yes, this is like one of my favorite parts. So when customers are going to their traditional financing, they are bringing everything under the sun in regards to documentation, right? They want your kid. They want all the information that you have. So what we do is we kind of make it streamlined. We don't ask for any income. Nothing that we do is based on your personal income. We're not getting a W-2 or a 1099. We're going on the performance of the property. What gives us that commercial touch is that we will lend to LLCs or corporations or businesses. So that's where we're commercial. We're not commercial in regards to we're doing strip malls or doctor's offices, but we're lending to a business. That's what gives us our commercial platform. We'll go up to $2.5 million. And of course, the renovation and construction exposure limits we do offer. So it gives you an opportunity to get approved one time and then have the ability to go and get money without going through the rigorous process of getting approved. So it's really a benefit working with us.
And so being the fact that it's asset-based, it provides some bigger opportunities.
Yeah, so on our rental properties, piggybacking on the last slide, we're not getting people's personal income. When you go to your traditional financing, most of the time they're looking at your debt to income ratio. They're saying, okay, how many deals do you already have on your credit report versus the income that you're bringing in? Well, we're saying, hey, we're doing something unique. Well, we're saying if the property were cash flow on its own, then we'll approve that loan. You don't need tax returns. There's not a property count max like it would be under the Freddie Fannie guidelines. And we'll even go up to 80% on your LTV on a purchase. So really awesome product to be able to have a fixed rate for 30 years based on the performance of the property and not your income.
Yeah, and without going through all of the details on this, and again, the slide deck, this is on the slide deck, so you can refer to this. It's also in the guidelines, but just, kind of looking at the comparison between the single rental and the portfolio rental, and not just the purpose, but, what you can look at as far as their loan size, terms, things like that is important.
Sure. So this is a great slide because it gives us a tail of the tape on both products. I'll start off hitting a couple of highlights on our single rental loan. So just giving a quick overview about what we call the SLP in our world, our single rental product, is that we start at a minimum loan amount, $75K. So you need to have a value of $100,000. It's a fixed rate for 30 years, which is what I really, really like about this product. We have a unique formula that we use. We don't call it the DTI, but we call it the property DTI, which is simply comparing the rental income to the overhead of the property, the taxes, and the insurance and your payment. If that'll cover it up to 85%, then you've got a loan. Probably my favorite highlight about the single rental loan is the actual prepayment penalty. Because most of your investors, they go into a project, sometimes they don't know what their exit strategy is going to be. Sometimes they go in saying, hey, I'm going to build this property, I'm going to flip this property, and they end up turning it into a rental. And this is an opportunity for them to have a fixed rate for 30 years. But if you'll pay close attention down there on the slide where it talks about the prepayment penalty, it's a 3-2-1 penalty on the single rental loan, which I really like. Meaning the first year is 3%. The second year is 2%. The third year is 1%. And after 3 years, there is no prepayment penalty. So you can sell the property, because sometimes you have rental properties and you want to take advantage of the market and you want to sell it. So this gives you the opportunity. And I'll, piggybacking the information into the portfolio, where you have a portfolio loan, but it's fixed for 5 or 10 years and has a balloon, and the prepayment penalty to get out of that is much more steep. So I like the idea of having that 3-2-1 because it's not a stiff penalty to actually sell, a rental property.
Absolutely. So let's go into a little bit more of the details then on that single rental loan.
Yeah, so the single rental loan is created to give an opportunity. I see someone asking the question about 85%. I did mention 85% property DTI. And what that means is when we do our formula, we're taking, the insurance, the taxes, and the actual payment. We're adding those things up, and we're comparing that to the annual income that you're getting from the tenant. We're using the lease agreement to use as our cash flow. So if we're doing a property that's vacant, I know that question comes up a lot in the single rental product, is that, what do you use if you don't have a tenant? Well, we use 90% of the market rent. So we say, hey, what is this property going to be renting for when you get a tenant? And we'll use 90% of that to use it as a cash flow so that you can take down properties that have never had a tenant in it at all. So it's a really good ordeal. Some of the highlights there again are, of course, we're not using income. We don't have tax returns. You can go up to 80% on purchases. And on refi cash out, you can do 75%, which is the most popular product. The majority of our pipeline are those who already own rental products and they want to be able to get the equity out of the property. So they come to us and we'll do up to 75% of the value if you've owned the property for at least 3 months. So if you've had it for 90 days, you can go and get the true LTV on it. I see a lot of people doing the buying, the upgrading the property, and then coming back and getting a refinance and actually taking advantage of the equity. We are opportunity to do that on our platform. So 75% cash out is a great ordeal. And of course, it's fixed for 30 years.
Absolutely. So, a lot of individuals, if they don't have already an idea as far as investors, where can they find these type of rental loans?
Great question. So one of the places that is an awesome resource for finding these type of investors is talking to the property managers. What a value add you'd have for them coming into their office, giving them a call, speaking about this product, because what it is a true value add. When property managers find out that we can cash out and refinance a property and get equity out, 75% of LTV, they know that they have an entire network of customers who can take advantage of that and buy more rental properties. And guess who's going to benefit? The property manager. Property manager is going to all of a sudden increase their business because their customers who they already have are taking equity out of their rental property and buying more rentals. So I would always start there. That is where we get a lot of our volume from. Turnkey rental providers. These are people who are in the market wholesale. They're out there and they know about people who are looking for rental properties, and they need a segue to get the capital. Realtors who work with investors, Facebook, LinkedIn, obviously social media is huge right now. So to be a part of these meetup groups and the local RIAs are full of investors who need this type of financing.
Absolutely. So one of the questions we're getting, and Brett had asked about rate and term refi, and we talked about cash out refi, and I can actually go back to that slide if you want to. How about rate and term?
Yeah, so our rates are generally between 6.5 and 8.75. The rates are determined by one's credit score. It's a minimum 660 to be able to qualify for the rental product, both on the single rental and the portfolio. And it goes up based on leverage as well. The higher the leverage, probably the higher the rate. So if someone is 80%, then their rate's probably going to be a little higher than someone that's getting probably a 65 or 60% LTV. So that's how we actually come
up with the rates. And then, so you have a 75% maximum LTV for a cash out. How about if it's just a rate and term refinance? Is that the same?
I'm sorry. It looks like Brett's asking a question. He's saying that I'm trying to understand his question.
So on, and maybe it's just a difference in commercial, Avery, because for what we have in our standard forward mortgages for residential, we have cash out, which means they're getting cash back. And then we have just rate and term, which means they're just paying off the note. And so on the commercial side, is it the same? And that's what Brett's asking. Is it the same, 75%? So it's the same. So Brett, it's the same, whether it's a rate and term or a cash out. Because sometimes you can go higher on your LTV if it's a rate and term as opposed to if it's a cash out. So whether it's cash out or rate and term. So either way, if they're getting cash or if they're just paying off, it's the same. So yeah, we got that.
Our terms are based off of the cash flow of the property, right? The performance. So the rate, the terms, the leverage points are based solely on that. It's not based on whether or not the customer is getting cash back or whether or not they're actually paying off and just refinancing the note. So it works the exact same.
Exactly. So a couple other questions. Are there asset requirements for this particular product?
Yeah, so some of the asset requirements are we require 6 months of PITI in reserves. That's the only thing that we require. So if someone has at least 6 months of liquidity in their bank account that will account for the payment or a vacancy, then that's the only qualification. And obviously, if you're purchasing a property, you need to be able to verify that you have enough to put down on the purchase. So if we're doing 80%, you need to be able to show that you have 20% of liquidity in your bank account to take care of the purchase.
Perfect. And so is there any required investor experience?
No, it's not. Great question. I actually love that question because we actually offer a line of credit now for our customers who don't have any experience in the fix and flip and new construction world. But our rental products have never required experience. The only caveat that we have is that you can't be a first-time home buyer. So someone has had to have at least experience with a home, a primary residence, or someone has had a mortgage, whether they've used an LLC or a corporation or their own personal name. That's the only requirement. But you don't have to have a track record like you would have to be required for a fix and flip or new construction. It's totally based on the performance of the property. If the property can cash flow and you've never had experience with an investment property, you can use this product.
Very good. And we're getting a lot of questions, which I absolutely love. I'm going to move on through a couple more of these slides, and then we're going to pull in these questions at the end. So let's get into the portfolio loan. So what we talked about was the single loan. So that is for someone that's just getting a single loan. But now let's get into the portfolio loan. And what's interesting in this, 10% of the single family rental market own 5 or more units. And so this product provides that. And you kind of talked in the beginning too, Avery, about, investors that have over that 10, Fannie Freddie has that 10 listing as far as properties that you can own. So being able to get into a market where you can get into actually creating a portfolio, this is an opportunity for this. And, it's interesting. I just recently did a workshop with millennials that were looking at getting into investing, and they really look at buying properties as investments. So how can you build that portfolio? So I love the fact that the portfolio offers that. So let's talk about some of the details of it.
Yeah, so portfolio is a great product. Our minimum loan size is $700,000. This is really built out for those who have an exit strategy of building out a portfolio because of the 5 to 10 year balloon. It doesn't have that flexibility like a single rental loan. We have daily customers come to us with a portfolio already in place, and sometimes if they hear about the single rental loan and the prepayment penalty, they tend to lean that way because they have the opportunity to sell the properties. But on the flip side, we have investors who only want to build out a portfolio. They only want to do cash flow in the units. They only want to have rental properties, and this is the perfect product for them. Some of the highlights is that we do 75% LTV on it. Again, there's no personal income or tax returns, and the minimum property that you have as a part of the portfolio is $50,000. But here's the other caveat to the portfolio product is that not only do we use this product to do consolidation of multiple rental properties, but we also use it to take down our multifamily. So if you have any units that are 5 to 20 units, this is the actual platform that we use, the portfolio. So small apartment complexes, small condo complexes that have multiple units, or if you have several units or homes that are sitting on the same parcel that are at least 5, this is the segue product that we use to take it down. So really great thing, really great product. A lot of people really, really like this product because it's designed to build and grow out your rental properties.
So let's look at, again, kind of some of those same things. And a lot of these are very similar to what we find as far as the single, where you can find these type of loans.
Absolutely. Back to the property managers that we talked about with the single rental loans is, going to the property managers, most of the time investors who are doing rental, they're doing rentals all the time. So they're looking for more debt. They're accumulating rental properties, as many as they can get within a year. So the portfolio help them, continue to grow their business while they pick up more rental properties, because Fannie and Freddie guidelines with traditional financing doesn't let you do more than 10. So us having the ability to grow your portfolio and put it into a portfolio loan allows you to now go back to traditional financing if you need to start over with more properties that way, if you've got better pricing, or if you just need to continue to add properties to the portfolio that you already have existing. Again, you'll find these people at the local REIA meetings, on social media, but I'm telling you, property managers is where this investor is definitely living.
Very good. So one of the things I want to get into, and we're getting several questions here. So before we get into our Q&A, I want to make sure we answer some of the questions that we have up here. And so Brett actually had asked the original question. And Brett, I'm seeing you raising your hand. I can't unmute you, so unfortunately you're going to have to type that in, but I do have contact information, so if it is a scenario question, you can contact Avery or your account executive too. So just so you know, but Brett made a good point that he has a client who used hard money to buy and remodel. And so
Mm-hmm.
now they just want to hold on to it. And so looking at that, you think about how many investors are out there that maybe took advantage of, the downturn in the market or maybe had an opportunity to buy a fixer-upper and they ended up using hard money. Then this is an opportunity for them to go in and to do a rate and term refi on that and get and pay off that hard money loan, right?
Yeah, absolutely. This is a way to take that property that they just rehabbed and came off new construction. They obviously don't have a tenant yet, but that's okay because we'll take 90% of the market rent. When we get an appraisal for our rental loans, they go out, and one of the big parts of the report is the market rent. We want to know what the property will rent for if it was vacant. So what we do is we take that 90% of that amount, and that's how we use the income for cash flow. We actually do that same exact exercise even when there's a tenant and there's a lease agreement in place. We'll take the lower of the two. So if the rent is $2,200 and then the market rent is $1,800, we'll take the market rent and we'll bump it up 105% because we know that the lease in place is cash flowing at a higher level than the market is. But that kind of sets the tempo for an opportunity. If we've got a 30-year deal and the property goes vacant, we know what the market is demanding. So if you're coming off of a rehab, you're coming off a new construction, and you decide that you want to take that investment property and get a fixed rate for 30 years and put a tenant in the property, you can do it even though you don't have a lease in place today.
Right. So let's talk about some of the cash flow on properties that don't cash flow. What are the qualifying requirements?
Yeah, so great question. So the property has to cash flow for us to be able to do a deal because everything's based on that formula that I spoke about earlier, the property DTI. So you got to have $1,000 of rent to cover $850 worth of overhead. So 85% is the cutoff of there. You got to have enough cash flow with a little bit left over to be able to qualify the loan. I saw someone ask a question earlier about what if it's one for one, right? What if it's $1,000 overhead but $1,000 rent? Then the loan doesn't work. So you got to take a lower leverage point. You can't go quite 75 or 80%. We have the ability to buy down the rate, just like the traditional mortgage. You can buy your rate down to make the payment a little bit less so that the property will actually cash flow because the loan is based 100% upon the performance of the property because we're not using income.
Absolutely. So on the portfolio loan, do you get a partial release if you decide to sell one of the properties down the road?
Great question. This is one of my favorite questions because this is what I was speaking about earlier when I was comparing the two products. I was comparing the single rental loan versus the portfolio. So if you've got a portfolio loan and you've got a consolidation of multiple properties together, it's a blanket loan, right? You decide that you want to take one of the properties out. It's going to be based on yield maintenance, right? Which is a much stiffer penalty to take one of the properties out of the portfolio versus if you've got each property on a single note, right? The prepayment penalty is a 3-2-1. But if you're taking one property out of a portfolio, I have seen penalties go up to 120% of the value to take that property out. Because portfolio is built to accumulate properties in securitization versus having one of the properties in there that you actually want to sell. It's a cash flowing product, right? So the penalty is a lot more stiff versus a single rental loan where you got just that 3%, 2%, 1% buy down, and after 3 years, there's no penalty. That's really the big kicker in the two products, single rental versus the portfolio in my mind.
Right. So next question, I think Kurt has a question. I think you answered it, but I just want to make sure it's the same. Can a property be sold out of a portfolio of multiple properties? And I think that's what you were just talking about.
Right. Yeah, so, we were talking about, I just piggybacked on that question in regards of someone being able to take out one of the properties that's in a portfolio, is it a partial release? We will release that property out of the portfolio, but there's a penalty. There's a penalty to take it out because these portfolio loans are locked in for either 5 or 10 years. Even though it's amortizing over 30 years, it still has that 5 or 10-year balloon. And all of these loans are in a blanket loan. So you want to make sure that when you're telling your investors and you're telling your property managers about this product, that the portfolio is really designed and built to be a long-term product for at least 5 or 10 years. It doesn't have that flexibility that a single rental loan has, where you can actually sell a rental property if you see an opportunity.
Absolutely. And so talking about, you had talked about a minimum of 7 units for the portfolio product. And so just confirming that if there's a 5 and 6 unit property, is there anything that can be done under that?
Yes, it can. I mean, our rule of thumb is 7 units, but we've had properties that come in that are over our $700,000 minimum loan amount that we can make an exception for. So if someone has a 5 unit or 6 unit, we prefer a 7 unit, but if it meets the value, if it's $1 million in value and we can do a $700,000 loan amount, we certainly will take a look at those. So don't run away if you have a 5 or 6 unit portfolio opportunity, because we will take a look at it, even though our rule of thumb is 7 units.
Right. And so we're having a question about fix and flips as far as using the rent that's either based on the current or if it's fixed. And there's actually a completely different product for that, which Avery hasn't talked about, right?
Right. Yeah. So fix and flip and new construction are 2 different products that we offer. We usually take those down with our line of credit or our exposure line, and our rental product, they sit on their own merit. So those are performance based, where we're not taking any income on these properties. They're based on the rent. And on our fix and flip and new construction, we actually approve the borrower for a line of credit. So we take a look at their track record. We take a look at the projects they've done in the past. We take a look at their liquidity. There is a liquidity requirement of $50,000 to have our minimum loan amount, which is $500,000 line of credit. So it differs a lot from our rental side, because on the rental side, we take all of those things out. We just want to know if the property will cash flow and it will cover, then we've got ourselves a loan.
Absolutely. And let's see, I'm going to get through a couple of these. We saw some on cash flow, and I think probably if you're having some questions on cash flow, it'd be best to talk to your account executive. And I have a question. Portfolio loan can be used for scattered portfolios as well as small apartment buildings. Is that correct?
Yes, we can do small apartment buildings, but we won't go over 20 units on a same parcel. So what that means is if you have a portfolio and you're accumulating other portfolios, you can put as many deals as you want. But where we put a threshold in the product is that we only allow 20 units on one parcel. So let's give an example. If I have 50 properties that I'm consolidating into one portfolio loan, and I have several of those are small apartment complexes, and they have 20 doors, I can put all of those together. But I can't put 25 units in one portfolio loan, if that makes sense. So I can consolidate as many houses as I want, but we stop on 20 units on one parcel. So I can do several parcels in this blanket loan, but we can't go over those units on that one parcel. So someone gets an apartment complex and they have 30 doors. Well, we can't do that. We can't do that property because that property is over our threshold of 20 doors on one parcel. So we could do 50 20-unit small apartment complexes in that blanket loan. So I hope I answered that question and it's clear.
Good. Yeah, no, and here's the thing, and I'm getting some actual scenario questions, and thank you for typing those in. Some of them are a little hard to get into on a webinar because it sounds like some of you are having some with mixed use and business and things like that. So on those scenarios, my best recommendation is to get a hold of your FAM account executive and let's run those by them, and then we can work through the scenarios on that. So with that in mind, I'm going to actually move on to, we have an FAQ put together of some of the most frequently asked questions, which some we've actually already addressed, but I'm going to let you kind of go through some of these on the highlights then, Avery.
Yeah, great. I'm super excited that everyone has so many questions. That means that people are listening and we're engaged and people are interested in these products. I really think a lot of the SLP and the portfolio. I was a manager over our nationwide rental products before we grew so large, and it's really been in my heart. So I'm passionate about it. I believe in it. I think it's a great value add. So I'm so excited that people are asking questions. So let's take a look at this screen that you got here now. These are some frequently asked questions that people ask about our portfolio and our single rental loan. One of my favorites is question number 4, where it asks, what if my client has a small portfolio of rental properties with fewer than 7 properties? Can we still help? Yes, this is something that I want to segue into, which is very, very common in our space, is that a lot of times people will start off with a portfolio of rental loans. And once they figure out all the options and opportunities that they have with our suite of products, they end up separating their portfolio because maybe they don't have 7 properties, or maybe their value doesn't add up to be over $1 million, where we can do a minimum loan amount of $700,000. So we end up breaking the portfolio up and using the single rental loan to take down the properties that they do have and putting them on a fixed rate for 30 years based on the cash flow. Now, all of a sudden, that portfolio that they had now has the flexibility to sell it if you need to. That's what I was speaking about earlier, about the opportunity to have flexibility in your exit strategy as an investor. We're building out a one-stop shop for investors. So we want to be able to service any clients no matter what their exit strategy will be. So if someone comes with a portfolio and it doesn't quite meet the criteria, or maybe it's a better opportunity for them to move it over to the single rental loan because of the flexibility and the prepayment penalty, that's a great opportunity to break down a portfolio and put them on a single rental loan. So I really like that question because we do that every day. Someone comes with a portfolio and they end up leaving with a single rental loan and breaking each one of the properties down on a single note. So I like that question. Do we offer interest only? Yes, we do. So we have a interest only option for our single rental loans where you can have a 5-year interest only. It helps the cash flow. So if you've got in your mind as an investor that you just fix the property up, you're converting it over to a rental property, and you want to see how the market goes, and maybe in 5 years you think, wow, the equity has really increased, and I think I can take advantage of a seller's market. Now you have the ability to do that, and the whole time you have the property, you only pay interest on it. So that's a really good choice for some of our investors who are looking to have flexibility. Again, we want to be able to have a one-stop shop to give all of our investors opportunities to meet whatever exit strategy they want or whatever they think they will be doing in the next couple of years.
Well, that's absolutely perfect. So one of the things I really want to go through is, how do you do business with Finance of America, specifically on the commercial side? I know there's a couple of different options.
Well, yeah, we offer an opportunity to do 2 different methods, right? We have a referral plan where you're saying, hey, I'm not an expert, you are an expert. We want to be able to lead you to the water, and you can take advantage of this opportunity by giving them the information that they need. So we say, hey Avery, hey John K, hey Kelly Soto, can you talk to this customer because this is an opportunity for them to find out about our rental products. And we do the work, we do the lead work, we do the engagement, and we get the deal to the finish line. Or there's an opportunity for you to sign up as a broker and broker out the deals, get the information, go through the training, go through the webinars, where we can turn you into an expert, where you can actually input your own deals. To be totally honest and transparent, we have a lot of people who choose number 1 because we know that you guys are doing other things in the market. You're busy with your own business. So to be able to be a referral and say, hey, I'm selling the sizzle. I know enough to be dangerous about the program, but hey, I'm going to give you over to an expert. Somebody who does this every day. They know the details. They know the formulas. They know the DTI. They know the information, and then they can get us to the finish line. Because it's all about a value add, right? You want the customer to have the very best experience possible. So we have both platforms, and I'm happy to talk to anybody about the process of being a referral or a broker.
And it's simple to do that. So if you're already approved with Finance of America Wholesale, all they have to do is sign a broker or referral agreement and get started with it, right?
That's right. Yes, it's really simple, really easy referral agreement. And even if you sign up as a broker, you still can go with the referral method.
And so if they do want to decide to broker, these are some of the licensing requirements as well. And so that's why referring is such a great opportunity.
Absolutely. When you refer, the license doesn't come into play. So if you're referring deals over, hey, I don't have license in this state, but in this state requires license, but I can be a referral, and then I can still get paid for referring over a deal that I'm not licensed in that state. So on one deal, maybe you're being a broker, and then one deal, maybe you're being the referral. It just really depends. But we give you a lot of opportunity to choose which path you want to do.
Which is really cool. So let's talk about some of the sales and marketing tools, because I know we have some really cool things that they can use. And let's start with the portal, which I think is important because it makes it very simple for them to be able to work on marketing, flyers, presentation, things like that, right?
Sure. We have an awesome platform to give out decks where you can actually put your own logo or put your name in. You can edit them. We have flyers that give out all the information. We even have product matrices so that you guys can digest what we talked about today, and also you can put your name on. So we have the awesome WLP 2.0 origination tool, which will allow you to put deals in and run quotes through our calculator. So if you're having a conversation on the front end with a customer that you'd like to refer and you want to be able to price them out, the WLP will allow you to use their calculator, and you can actually tell them their terms before we even get started. You can say, hey, I can do this loan for 6.7%. It's going to be fixed rate. And by the way, we're going to give you 80% LTV. So it's an outstanding tool. So I would highly recommend everyone to get their credentials for our WLP portal so they will at least have the access to the calculator.
Perfect. And then the marketing flyers that are available, as you said, you can just go in and personalize those, drop your logos in, and just use those. So you don't even have to think about doing anything. So what's the next step? Someone who has never done business with Finance of America Commercial, what's the next step they need to do?
Oh, well, you want to reach out to your FAM AE today, and you want to make sure that they can get you hooked up and get signed on as a broker or as a shop under Finance of America, so you'll have access to Finance of America Commercial. We do weekly webinars, so I would highly suggest after you get signed up with your AE to come over and attend one of our webinars so that we can give you the proper training. We cover all of our products. We cover the WLP, and we also do personal Zoom meetings if you have clientele that are interested in our product. So it's an awesome way to drive business and really grow your business on the commercial side.
Yes, and then you can find all the resources that are available in Finance of America University, which the flyers, the training, and everything is there. So we're going to stick around and do some Q&A. If you need to hop off. If you want to listen to some of the questions that Avery's going to answer, you can do that. Jill had noted that she could not access the presentation, and I can access it fine. So if anyone else is having problems, let me know. But we do always send out a follow-up email. So Jill, we will send up a follow-up email to you tomorrow. It'll have a link to the presentation. It'll also have a copy of the recording. So I was recording all the presentation. So tomorrow you're going to get an email from me. That email is going to include a copy of this recording as well as the slide deck. And so if anyone else was having an issue downloading that, please let me know. As I said, I just clicked on it and opened fine. So sometimes your firewalls can block certain things, especially on these webinars. So if you ever have any problems, by all means, let us know because we want to make sure we get that to you. So Avery, you want to hang out for a little bit and answer some questions?
Absolutely. I'm looking at the chat now. I see Kevin Strange is asking a question about, is there a limit to the number of single rental loans that you can have? There is no limit. We differ from traditional financing. You can do as many single rental products as you want, as long as they're cash flowing. Every single property sits on its own merit. And here's another good caveat to that. Earlier, we talked about what was the liquidity requirements for our single rental loan. You can actually use the same liquidity for multiple rental products. So you could have, 5 or 6 rental loans going, and you could use the same 6 months of reserves for each one of them. So if I've got, $20,000 sitting in a bank account, I could use that same reserve for every one of my loans that I'm getting. We don't subtract 6 months of reserves because you're doing a rental loan and then you decide to do another one. We say, hey, the same liquidity stands strong for each rental property that you have. So no limit.
That's really cool. And it looks like we are getting a couple of questions, Avery, on mixed use commercial. So you want to address that?
Yeah, great. So we are currently building out a new mixed use product right now. The way that our mixed use product lies is we will do it. We will do a mixed use, but it's got to be 85% residential, which sometimes that only allows for a really, really small shop. We'd like to dive into the space where we could have a townhome or a condo sitting above a Starbucks or your local watering spot. But right now we're building that out. Today, if you were to do a residential mixed use property, it would have to be 85% residential.
Perfect. And another question is, every property in the portfolio required to be appraised?
It is. Great question. So in our portfolio, every property will have an appraisal, but we order a special appraisal. We do a blanket loan appraisal. So there'll be several properties in that blanket that will receive an appraisal, but the appraiser will go out to each property and actually go inside the property. So it takes a little while. It's not, it doesn't move as fast as our single rental loan because you have to have an appraisal on each property. But yes, the short answer is yes.
Okay, very good. And so it looks like that is all of our questions that I'm seeing that have been answered. I'm going to go through. Oh, we have for guidelines for interest only. So under the interest only, can you use the IO feature to qualify for the cash flow requirement?
Yes. When we run the terms, we also include the 5-year IO. So sometimes you're exactly right. If you were to do the interest only, it increases the cash flow. And sometimes that is the determining factor on whether or not the property will actually work. So if you're right there on the borderline of 85% property DTI and you go to an interest only format, that could be the difference in the property actually qualifying and not qualifying, because then you're taking out the principal on the payment and you're only paying the interest. So yes, that we do that and we see it quite often. And the 5-year IO really helps the cash flow because you're not accounting for the principal.
Right. So Tom is asking as far as explaining some of the color coding on this map. So I brought the map back up for licensing requirements. And it looks like, Tom, is it New Jersey, New York, or Pennsylvania? Let me know specifically what states you're looking at. And then Avery can kind of drill down on that. But he's asking as far as what each color represents and how it's different.
Yeah, if you look down below, we've got a key down there for the colors. Like, for instance, green, you need no license, right? The state of Georgia, your licenses are not required. And then the states that are in this dark gray, almost black color, we're not lending there today. Like North Dakota, South Dakota, Utah, we are lending in Vermont, so that needs to be changed. But we are lending there now. But those are the states that we don't lend. All the others we do, but there's requirements based on these colors, like shop only must be licensed, or shop only must have broker, banker, lender license, or hey, shop and broker must be licensed. There's different scenarios depending on the state, and that color code helps you go over that state by state.
And the license is different. So we're not talking about the same license as the NMLS. What we're talking about is a commercial license. And so that's why that it's important to understand this. It doesn't mean you can't do these types of loans. It just means that, if you happen to be in a state that say you're in Kansas, and so your shop must have a broker, banker, lender license, and the broker must be licensed. So there's some licensing requirements on the commercial side within the state of Kansas. And so with that, that's okay. You can still do business. It's just you're going to end up looking at this as far as referring rather than brokering.
That's right.
So those are the main differences there.
That's right.
Okay, so Tom says, yeah, he's licensed in New Jersey. And if you're having additional questions on that, what I recommend is contact your Finance of America account executives, and then they can help you to figure out which one makes sense. So Tom, you're licensed, so you are in New Jersey. And so New Jersey shop only must have the broker banker license. So that's one of the things to look at in New Jersey. You can still do business, but if it's something that you're going to be doing a lot, then it's something to consider. Hey, maybe I want to get licensed, and you can look into that. So those are the kind of things. Okay, so I think that's it. I think we answered the appraisal question. Yes. I just want to make sure we answered all the questions, and it looks like we have. So we are going to close out, and I want to remind everyone to contact your Finance of America account executive. And if you do have any questions, to contact them. And Avery, I want to thank you for taking the time and being able to share this information. I love listening to you talk about this. Your knowledge is incredible. Your passion, absolutely phenomenal. So I thank you for this, and I look forward to having you on a webinar coming up in the future. And I wish you all a great week.
Thank you so much. Thank you so much, Ginger. I really enjoyed it, and I hope that I brought some value. And anybody that was on the webinar today, you have free range to reach out to me for any of your questions or any feedback, or if you need to jump on a quick call. It doesn't matter where you're located or who your AE, who you've been working with. I'm happy to answer questions and bring value any way that I can. So thank you.
And I love that. You're awesome about that. Thanks, Avery. Thanks, everyone. You guys have a great day, and we'll see you on a webinar coming up.